The best way to explain financial ratios is through an example. We have here the balance sheet and income statement of Alexis Company, a public limited company in England which operates a wholesale carpet business. A public limited company is what we commonly know as a corporation. This is from the book Financial Management by Peter Attrill. Before we start our detailed look at the ratios for Alexis Company, it is helpful to take a quick look at what information is obvious from the financial statements. This will usually pick up some issues that ratios may not be able to identify. It may also highlight some points that could help us in our interpretation of the ratios. Starting at the top of the statement of financial position, the following points can be noted. Looking into assets would reveal that there was an expansion of non-current assets. These have increased by about 15%, from 510 million to 587 million. Note 7 mentions a new warehouse and distribution center, which may account for much of the additional investment in non-current assets. We are not told when this new facility was established, but it is quite possible that it was within 2019. That expansion appears to have not really benefited the operations in 2019, because while sales revenue expanded by about 20%, from 2.240 million to 2.681 million, cost of sales also increased by 30%, from 1.745 million to 2.270 million, resulting instead in a decline in gross profit from 495 million to 409 million, or a decline of 17.37%. There are also major expansion in the elements of working capital. Inventories increased by about 35%, trade receivables by about 14%, and trade payables by about 36% between 2018 and 2019. There are major increases, particularly in the inventories and payables, which are linked because the inventories are all bought on credit as mentioned in Note 2. We can also observe here the reduction in the cash balance. The cash balance fell from 4 million in funds to a 76 million overdraft between 2018 and 2019. The bank may be putting the business under pressure to reverse this, which could create difficulties. Comparing the non-assets with long-term borrowings indicates that the business have assets to offer as a security or collateral for future borrowing. This is because potential lenders usually look at the values of assets that can be offered as security when assessing loan requests, and lenders seem particularly attracted to land and buildings as security. As of March 31, 2019, for example, non-current assets had a carrying amount of 587 million, but long-term borrowing was only 300 million. Carrying amounts are the value at which they appeared in the statement of financial position, and carrying amounts do not normally reflect market values. Land and buildings are often shown in the statement of financial position below their market value. This is due to a general tendency to inflation in property values. Now, going back to the income statement, as mentioned earlier, sales revenue and cost of sales increased between 2018 and 2019. Further, operating expenses rose by a greater percentage, leaving both gross profit and operating profit massively reduced. The level of staffing, which increased from 13,995 to 18,623 employees, or by about 33%, may have greatly affected the operating expenses. Of course, without knowing when the additional employees were recruited during 2019, we cannot be sure of the effect on operating expenses. But we know that increasing the number of employees by 33% must put an enormous strain on management, at least in the short term. It is not surprising, therefore, that 2019 was not successful for the business, at least in profit terms. Having had a quick look at what is fairly obvious, without calculating any financial ratios, we shall now go on to calculate and interpret some.